Welcome to The Beehive, the podcast where we explore the latest trends, challenges, and strategies in the world of finance and corporate governance. I'm your host, William, and today's episode is all about revenue recognition. We'll walk through each step of revenue recognition, cover key concepts, and point out common industry challenges. Joining me today are Junel and Glee. It's great to have you guys here. First, we have Junel, one of our revenue experts who is knowledgeable about revenue intricacies and how they affect financial statements.
Hi, happy to be here. I'm excited to share my insights and provide a clear picture of revenue recognition for everyone.
Happy to have you here, Junel. We also have Gliezel, a technical accounting director with years of experience helping clients navigate the peculiarities of revenue recognition. Today, she will share insights on how these technical concepts apply to different industries.
I appreciate the opportunity, Will, and I'm looking forward to discuss this topic.
Yeah, just a quick question. How many years of experience do you have in this industry?
I've been with this industry for a total of 15 years.
Wow, that's a very
my-
long time. A very, very long time. Together, Junel and Gliezel will offer valuable insights into the evolving landscape of accounting for revenues. Let's dive in. So I wanna focus on one key term here, which is revenue. It's a term that's everywhere and it's a crucial part of income statement. Actually, it's a crucial part of business itself. But I wonder that are there still issues with something that seems so basic?
You'll be surprised. We've seen many companies that struggle with complying with ASC 606. In fact, it's a regular part of the top 5 SAC comment letters, specifically those areas in terms of revenue recognition that involves estimates and judgments.
Well, let me take it a step back first. So, what is ASC 606 compliance, and what is the top five you said, top 5 SEC comment letters?
So, ASC 606 basically shows us and guides the companies on the 5 steps of revenue recognition model. And to simplify those 5 steps, it's identifying contract, determining the performance obligations, determining the price, allocating the price based on the obligations, and recognizing revenue itself. So common concerns, I believe, from that recent SEC common letters revolve around identifying performance obligations, identifying variable considerations, among others.
As well as the principal-agent relationships and some of the disclosure considerations. And to add for that, SEC common findings. So SEC regulates listed entities in the U.S. So regularly they review their financials. And ever since the U.S. GAAP introduced this new revenue standard, ASC 606, it's been part of the common SEC findings.
Yep, so we'll get ready because there's a lot to talk about.
That's a lot. Actually, there's a lot of things to consider. Maybe too much information for me to handle at this point. So I want to break it down with the 5 steps that you have mentioned, right? What is the very first step in that? And maybe my first question is, can we discuss some of the most common challenges with that first step?
I think there's no better way to start those issues by the first step, which is identifying contracts. Certainly, there are issues regarding this first step when there's no written contract. Because commonly, when I say the word to you, Will, contract, you often imagine a piece of paper. But what if there's none? What if there's no formal contract? Well, we can still have a valid contract even if it's not written or even if it's informal. Think of small businesses and local shops. So when we avail of their services, instead of signing a formal contract, what we do is we just agree to their common terms of conditions or rules. So another instance could be hospitals, for example. A few months ago, I feel sick and I scheduled a procedure and went to the hospital for treatment. So even if I haven't signed a formal contract with the hospital, the fact that I scheduled an appointment and went to the hospital, that's already an implied and binding oral agreement. So it's already a valid contract in that case.
Yeah, just to add, probably the contract actually determines who is the performer of the obligation and determining if there is a customer within that agreement, as well as the obligation or the promise between the parties of the contract.
Right, certainly. So as long as those conditions that Glee pointed out exist, even if it's not written, a contract can be valid.
And how would that how would that be documented? For example, if it is just like an acknowledgement, as you've mentioned for the small business or local shops, is you've mentioned that like an acknowledgement could be like a form of valid contract. How would that be seen, for example, in legal terms?
Um, Actually, it can be oral contract. So basically, we've discussed you want to buy something, and then I provided that goods or service. So basically, we were just determining the meeting of minds or the agreements. So it will trigger the revenue recognition.
Oh, so you got to be careful about what you say,
Yeah.
especially in a meeting. That's very, very interesting, and especially as maybe for someone who's trying to start a business, or someone who's already in a business, but it's not really adept in like the legalities of maintaining a business. I think this is very, very important. But aside from what you mentioned, I just want to clarify concerns regarding assessing collectability. Although it is often like an issue to estimate the credit losses, could it also be present? Could it also present an issue in like identifying contracts?
Certainly, in terms of collectability, this is where a bit of judgment is involved because we need to assess whether a customer is able to pay, has the capability and intention to pay. Of course, you can just look at a person and then assess based on that. I think this person won't pay or not, right? So what we usually do for existing customers is we review their existing payment history. However, for new and potential customers, companies usually review their credit score, their financial statements, and also references from other suppliers regarding their intent and capability to pay. So, by gathering this data, it helps companies to make informed decisions and they also adjust payment terms to manage the risks.
Is there a standard or general guidelines in terms of assessing someone? Like for example, I can imagine a bank assessing my credit score, but is there like a general guideline that they kind of follow, or do they just like, I think this guy pays enough. This guy's credit score is good. All right, let's have him in.
Usually, it's based on their historical record in terms of the transactions they went through. Even though the standard itself does
Mhm.
not have an explicit statement on the ways to
Ah.
assess it, but common practices, depending on the industries,
Mhm.
could be considered to assess the collectability.
Yeah, there's actually no general guide on it. Definitely when we sell, our objective or goal is to collect. But say for example during COVID times, post pandemic, there are instances that when you assess and do a high level um, check on the high level background check for that potential customer, we see that probably they have challenges paying their dues or probably they're filing bankruptcy. So that can be an indicator that they might not be able to collect. Say the supplier's intent is really not to collect or the buyer's intent is really not to pay. So that's part of the assessment as well. The collectability is being assessed on two phases at the onset and thereafter. After we provide this goods or service, we're continuously assessing the collectability, but that's now outside the scope of the AAC 606 standard.
Thanks for clearing that up. So once we've identified the contract, which you guys have stated is the very first step, what is the next step after that?
So the next step is identifying the performance obligation. I like what you've mentioned earlier, Will, that be careful on what you say or
Yeah.
commit because that's the obligation. So let's start with the promise. So in the contract that we've discussed earlier, I've mentioned that there are promises on that contract. And that promises needs to be distinct for it to be identified as a performance obligation. So it's possible that there are multiple promises that can be tagged as one performance obligation, or in some instances, there might seem to be just one promise, but if you
Yeah.
analyze it, uh, there might be a multiple performance obligation in that
Within that one promise.
within that one promise.
Okay.
So just to share, I shared that it's distinct. So I remember I was the client called before, and the client asked, "How can you say it's distinct? What do you mean by distinct?" Yeah, distinct means it's unique. It can stand alone, but in the context of ASC 606, distinct. The promise is distinct if the customer can benefit already on its own or with other available resources like outside of that of the supplier. Another is it's distinct in the context of the contract, meaning it's not reliant on the other promises within the contract.
So it can stand alone by itself. That, that makes sense. That makes sense. What kind of arrangements does it make it tricky to separate performance obligations?
Actually, it's really tricky, especially say companies are offering packages. So, for example, a SaaS industry, software as a service companies. So usually they offer a package. Say they're selling a software or a license, and they're also offering post-contract customer support, say updates on that software. So if the customer can benefit already on that software and it can get updates to any other companies, then there are two performance obligations. One is for the software and second is for the update. So the transaction price will be allocated between the two because that's two separate performance obligation. And say the software is an IP, so revenue can be recognized upfront immediately. And for the updates, since it will be provided over time, then the revenue will be recorded over time. But say on a other scenario where the updates can only be provided by the company. So while there are two promises, the software and the updates, it will be treated as one obligation. And therefore, the revenue recognition on that will be over time. Just to add, over the past years, the SEC has continued to seek more details about how companies identify performance obligation with their contracts with the customers. It's critical to identify this correctly as it will have a domino effect and ultimately impact the revenue recognition. And actually to add, we have a fast talk about revenue recognition for the SaaS companies. So feel free to check it out in the Scrub website.
All right. We'll make sure to include that link in the description below so everyone could check out that article. Moving on, we've already discussed the performance and obligation. How should we then map the transaction price? Because I think that's also something maybe for me who's not really adept at this industry is maybe interested in. Is it maybe as simple as just using the amount listed in the contract?
Yeah, I wish it were simple as that, like if we can match it. But complexities arise, say if we have a significant financing component, as what Junel mentioned earlier, financing. Others that if there are non-cash considerations and other variable considerations.
Well, let's go through them one by one. Like, when does a transaction price include, a significant financing component?
Sometimes it's explicit in the contract, sometimes not. So if it's not explicit in the contract, so that's the challenge. So we use the ASC 835-30 as a guide.
So there's another specific
there are
contract.
Lots of standards within the US GAAP framework. So we'll use that guide. Also, we consider if the terms is outside the normal business course or if the collection will be more than a year. So those are the triggers that there's a significant financing component. So if there's a significant financing component, while this is the transaction price, we need to extract how much is the interest related to that. And then we account that separately, interest over time, and then the price of the goods or services, either point in time or over time.
Yeah, so I'm a little bit concerned about because there's a lot of contracts here. Is there a way to, in the process of making these contracts, is there any quality assurance involved? What I mean by that is, say for example, we're already making up a contract, right? But maybe there are some human errors that we maybe have overlooked. Is there a process that allows us to, okay, let's have a look at it one more time, or let's pass it on to another person for them to look at?
Actually, the challenge is that, for the contract, I think it's as is because it's based on the agreement. The challenge lies on the analysis of the contract, because it's written, yes, but how should you account for each of the terms? It might seem simple, but when we further analyze it, we missed accounting it separately. So it's really important to have another individual or technical accountant help you review the contract.
Well, yeah. So aside from you've discussed the timing of the payment, right? So aside from that, do we also consider, or do we also encounter issues with the transaction price based on the kind of payment the customer makes?
Yeah, actually, the customer can, um, aside from cash, the
Mhm.
customer can also give goods or shares in exchange of the goods or services. So those are non-cash consideration. So the reminder here is that if it's a non-cash consideration, the transaction price should be based on the fair value of that non-cash at that contract inception. The ASC 606 actually released an update to explicitly include that.
Can I just ask, do you have in your experience with clients, is there a lot of clients who have a hard time trying to understand all of this?
You know what, Bill? That sometimes companies think that it's straightforward, so they seldom consult, and that's why probably there are lots of SEC findings or observation. But when there's a trigger and the clients ask us to check, then definitely we identified different accounting different ways to account those items as how they initially account those.
That makes sense. Yeah. So, you've also mentioned variable consideration, right, a while ago. How do we account for them?
So for variable considerations, the definition is basically if you meet a certain condition, you'll either pay more or pay less. So when you pay early, you can get a discount. Or if you meet a certain threshold of the sales, you'll pay 5% royalty. But then when you exceed another threshold, you'll pay 10% royalties. So that's why it varies, hence the term variable consideration.
It's like a reward or a penalty.
Perfect. Yeah.
Yeah.
So that's why we only consider the variable considerations in the transaction price if we are sure that we won't make any significant adjustments later on. That's why it's important to consider the method of valuing or determining the value of this variable considerations. Two of the most common methods is expected method and most likely amount method.
So in practice, though, there are complicated procedures, like, I mean, in terms of these methods, but on a surface level, can you give us like an illustration on how each method works, and maybe how do we choose which one to use?
Sure. So here's a simplified example. Let's try to play a game. So imagine there's a box and your task is to pick a bill out of this box. Inside this box, there are 4 bills. There are 3 $100 bills and one $20 bill.
Okay.
So here's the exciting part. Whatever you pick from this box, Glee will pay that amount. Just kidding. So under
Happy birthday to me.
under the expected value method, the value of your pick will be based on the chances of what you will draw. So let's say there are 3 out of 4 of $100 bill and 1 out of 4 of $20 bill. The average of that is 80. So we'll value your pick based on that average. So $80. Yeah. But when we use the most likely method, we simply ask ourselves, well, what's the most likely amount that you will pick? And that's $100 bill because there are 3 of those in the box. In terms of the standard, it does not necessarily prescribe a specific method to use. However, in practice, when we are only choosing 2 possible outcomes, we use the most likely method. But if there could be multiple outcomes, we use the expected value method.
I kind of get it. That's because that's a great example, simplifying it for me. I'd like to revisit how we allocate the transaction price based on you have mentioned before performance obligations, right? What would be our advice to our listeners on how to allocate the price? What would be the common challenges in this area?
Yeah, on the allocation of the transaction price, usually definitely it should be based on the standalone selling price of each of the performance obligation. Say, for example, the SaaS companies that we were discussing earlier. So for, say, the package amounts to $270, and we have the software which they sell for $200 and the PCS or the update for $100. So we need to allocate the 270 between the software and the updates. So we allocate it proratably. So it's based on the 200 price of the software over the total price of the performance obligation. So 2 over 3 times the 270. And then for the updates, it's the 100 over 300 times the 270. But it's a simplified explanation. Issues arise when the standalone selling price are not given, like we don't know what's the price of the updates.
Right. So what happens when the standalone price is not given? Like, how do we estimate that?
The standard doesn't prescribe a specific method for estimating the standalone selling price, but it provides a few approaches. Say, market approach: how much is the market willing to pay for that item? Cost plus method: so how much is the estimated cost plus the certain markup, or in some instances, the residual approach if there are limited information given.
Are there any specific industries or businesses that don't really have like a standalone selling price?
Well, it depends. Because if they actually not selling it separately, it's really challenging. One industry I can think of aside from SaaS are the life sciences industry. So, for example, they have identified standalone selling price for certain drugs, but then they're selling, say, royalties or licenses, which they don't have a specific price for that. Then it becomes challenging. Like, how are you going to allocate a price on that one?
All right. So it's a lot of challenges, especially when dealing with different kind of industries in this case. All right. So we've covered a lot of ground, but let's get to the heart of the matter. When exactly do we recognize revenue?
We recognize revenue when a performance obligation is fulfilled. This can happen either at a point in time or over a period of time. For example, for long-term construction contracts as well as prepaid subscriptions, commonly they are recognized over time and they are recognized as revenue gradually as the work is done or when the service is provided.
Why is it important that we have to have this like as a final step to properly recognize the revenue? Because I would imagine that even in the start, there's already maybe a baseline of like, this is probably the revenue, right? Aside from having all the complicated matters that we have been talking about, why is it important that we really have to recognize the whole revenue thing?
Actually, that's the trap, because sometimes companies already have their assessment na, oh, based on my experience, it should be at the onset. But then if we go through one by one through the steps, that will aid us to properly identify if it should be at the onset or over time.
Yeah, and could you imagine if you did all of those steps correctly? Those steps that we've mentioned a while ago, and then you committed an error at the last part. So that will throw away all of those efforts. To put it into perspective, Will, let's say we erroneously recognize something as a point in time rather than over time. So if we said that 100,000 worth of sales should be recognized at a point in time, then in the first year, we recognize the entire thing as revenue, 100,000. That seems good, right, in terms of our investors when they look at our financial statements. But that's misleading because if in reality, it should be 20,000 per year for 5 years, you see the impact in terms of the amount. So it will really misconstrue or it will really misrepresent the status or the performance of the company if we misallocate or we have classified it at a point in time instead of over time or the other way around.
Are there any instances where, and I'm talking about maybe the negative side of this example that you gave, where businesses or maybe the firms that these businesses hired use this kind of false leading information to their advantage? Are there any cases like that?
Pairing revenue based on what they think should be the accounting one. And after a few years, they were either audited or they were acquired and there's a need to revisit their revenue recognition accounting. Then they might need to redo or restate their prior year financials.
So, yeah, going back, if a revenue is recognized over time, right, does the standard mandate a specific method to maybe measure how much revenue will be booked each period?
So it doesn't give a one-size-fits-all answer, but the standard gives certain approaches that the companies could use. For example, they could use input methods such as how much resources have we already spent over our total estimate, and how many hours have we already put in. We could also use output methods such as what's the progress of this building that we have been constructing over the years? What's the percentage that it's done? Or it could be the certain milestones that we've already achieved.
So I want to ask the same question, but in the revenue recognition when it's considered a point in time, because we've talked about this one is overtime, right?
You're right.
Okay.
Certainly. So for revenues recognized at a point in time, the most important term is control. So when the customer already controls those goods or services, then revenue should be recognized at that point in time. So there is control, or the control is already transferred to the customer when they start using and benefiting from that particular product, and they can prevent others from doing so. There are certain indicators that the standards have given. For example, there could be control if the customer already has physical possession, if the customer has legal title, or if they already have significant risks and rewards of ownership.
Is there any gray line to this control? Because maybe someone has the legal title, but someone else is in possession of that legal title, or maybe you've mentioned the significant risks and rewards of ownership. I want to know more about what is the gray area of this, because I imagine there's a lot of complicated matters to deal, especially with the issue of control.
They're just useful hints, but they are not absolute rules. So indeed, there's a gray area. For example, in a bill and hold or drop shipping arrangement, a customer might ask the seller to hold on to the goods because they don't have the space to take the goods yet. So in that scenario, the seller still has possession of the goods, right? But if the seller already have segregated those goods, and those goods are specifically for that customer, even if the customer doesn't have physical possession yet, the seller under that arrangement can already recognize revenue.
So what about the opposite case? Can goods be delivered to another party without transfer of control?
Yes, that happens under consignment arrangements. Let's say I'm the manufacturer or the consignor, and I'd like to share and sell the goods to you, the customer. But you live in another area, and how would I do that then? What I do is I ship the goods to a local store, which will serve as an agent. So I'm the principal, and the local store is the agent. When I transfer the goods to the agent, there's no revenue yet because it haven't been sold to you. So it will only be a revenue when you buy from the local store those goods that I'm selling. In that scenario, the consignor will only recognize revenue when the customer buys the goods, not when I transfer and ship the goods to the store, to the local store. So that is also how the principal and agent works, where I am the principal and the local store is the agent.
Yeah, it's great that we're touching on this principal and agent roles, because I think it's also a little bit too complicated for someone like me who's not really adept at this topic, So how does being a principal or maybe an agent influence how revenue is recognized?
Yeah, so let me answer that. So for the principal versus agent assessment, the parties' role determine the performance obligation of each of the parties, as well as the portion of the transaction price that they will record as revenue once they performed the obligation. So for an instance, let's say in an online marketplace, a customer purchases a pair of shoes, and the marketplace only serves as intermediary, facilitating the sale between the seller and the customer, so that intermediary is the agent, and thus the revenue that should be recorded by the intermediary should be only the fee to be paid by the seller. And then the seller, as the principal, is the one recording the gross amount of revenue and recognizing the portion of the fee paid to the intermediary as its expense. So the principal versus agent is also one of the common SEC observations or findings. So it just to share, in a three-party arrangement, or in the assessment of principal agent relationship, it's essential to identify who is actually the customer. Is it the intermediary or it's the end customer? Because that determines their role. This distinction determines their role as a principal or agent, which in turn impact how they will recognize revenue. And again, a key indicator is the control. So it's either we need to identify who is responsible performing the obligation, who bears the inventory risk, or who determines the pricing. And again, to add, we already have a blog about this, principal versus agent, so they can check that blog as well.
Amazing. Right. Just um again, we'll put that link in the description below for our audiences. So I think that example has shed some light for someone who's not really knowledgeable about this topic, but so I think we're nearing our time right now. So as we wrap up this episode, do we have any final reminders for our listeners?
Before concluding, we'd like to note that we haven't touched yet the disclosure requirement. Again, disclosure is critical part of the financial statement reporting, as well as, again, common SEC findings. So for the companies, as you prepare your financial statements, kindly refer to the financial statement disclosure checklist and the ASC 606 as a guide for your disclosures. Also, as additional reminder and as we wrap up, again, it's not a one size fits all. So it's crucial to perform a detailed review and analysis of the contract. Pay extra attention to those requiring estimates and judgment, and definitely consult with your technical accountants.
It's great that you mentioned that, Glee, because certainly there are so many complexities as we have talked about, from the first step, identifying contract, until when do we recognize revenues. And it's not as straightforward as it seems. That's why I just have to remind everyone again to make sure to pay to those details that Glee have mentioned, as well as consult your technical accountants.
Amazing. Well, there you have it, folks. We've covered a lot of ground on revenue recognition and this ASC 606 thing today. Thank you, Junel, and thank you, Glee, for your insights. And it's clear that revenue recognition, while a familiar term, is not as simple as it seems, which we have said multiple times this podcast. There are a lot of factors to consider, and even the same products or services can be accounted for differently, depending on the specifics of the circumstances. Remember, to our audience, understanding ASC 606 is key to accurate financial reporting and steering clear of costly mistakes. Should you have any related concerns about this topic, feel free to reach out to us or to the technical accounting group to simplify complex revenue issues. Thank you to our guests for sharing their insights, and thank you to our listeners for tuning in.
Thank you for having us. We really enjoyed the discussion.
Thanks, guys, and make sure to check our blogs.
All right, we'll see you guys next time.